This is what really got me going, was this person saying, "Let's go!" Dude, how's it going, guys? Welcome back to Investing with Edwin. And yes, you read the title right. How to make wealth slowly. Yes, in these days, y'all, I understand that in order to make money fast, you need to do a lot of hustling and a lot of businesses. And everybody wants to get rich fast. Everybody wants to gain a lot of wealth. But it takes discipline, it takes time, and it takes effort. And most importantly, it takes knowledge to understand what you need to do in the stock market and real estate and any other thing. So if you want to get rich quick, if you want to get rich fast, this video is absolutely not for you. So I suggest maybe looking at another video or maybe joining some kind of scam that'll show you how to get rich quick. But in all means necessary, if you do find the formula by any chance on how to gain wealth really quickly, then put it down in the comments and I will shout you out in the next video that I post. But in all seriousness, we're going to be talking today about index funds. And what better way to do it than to follow and look at the steps of one of the most successful investors out there, also known as Warren Buffett. So stay tuned as we take a ride into these index funds. Known as the Oracle of Omaha, Warren Buffett is one of the most successful investors of all time with a net worth of $84.6 billion. You know, he kind of reminds me of Uncle Scrooge, swimming in all those gold coins, because this man is legit. He is legit a successful investor. And it's hard to believe that this man was born in 1930, literally before World War II. At the age of 90 years old, he is close to having 1 billion per each year that he's lived. That is so insane, you know. That is a very successful investor. Hence the reason why we're going to listen to Warren Buffett. We're going to listen to success. Why would we listen to people? Why would we follow the steps of people that are not successful? But you know, the most interesting thing about Warren Buffett is that his method is so simple, yet no one wants to listen to his advice. No one wants to take the time to invest in long term. Everybody wants that short, everybody wants that quick money, everybody wants it quick. But as successful investors and how we're gonna try to do the best to follow his steps in for long-term wealth. Beyond his value-oriented style, Buffett is also known as a buy and hold investor. This means he doesn't sell stocks for the short term to make profits, but instead he chooses stocks that he believes are good prospects for long-term growth. And this is with any stock that you choose, that you invest. Choose stocks that are good for the long term. So how did he make his wealth so slowly? Well, a little background history. This investor mentality led him to make investments in Berkshire Hathaways. Eventually, his heavy investing leads him to shift the views of Berkshire into a holding company, meaning he began to invest into other businesses. And that's why the stock market is all about putting your money into companies that you think will do well, say 5 or 10 years from now, investing for the future. And I know this is hard to hear, 5, 10 years from now. That's such a long time. We don't know where we're going to be 5, 10 years from now. But I know it's also especially hard after hearing the news from GameStop where these stocks have surged and you've heard of people making thousands and thousands of dollars on this stock. And I know there was a huge wave of investors that began to start investing in the stock market because of GameStop. And that's good, We should all focus on financial literacy and trying to gain wealth. But unfortunately with GameStop, if you weren't in Reddit and if you weren't in Wall Street Bets a couple of months ago, I'm sorry to tell you this, but this train has gone by already. The investment of this stock went from like $3 all the way to, I think right now it's like $200, $300. But you can still make moves that will improve your wealth. And I hope you hear me out. Putting your money in stocks just because of the hype will only cause you to lose money and to lose value because you don't know what you're investing, you don't know what the research is, and it's just very likely for you to lose money. And I tell you this because it's happened to me. You see, when I first started investing, I was in this group chat that would notify you what stocks to look at, when to put your money in, and when to put your money out. I was listening to other people without doing any research whatsoever. And in this case, when I first started investing in the stock, I looked at this penny stock. Now, I don't remember what exactly the stock was called, but let's call it EBR because it's just some random stock that I found on the internet, and we'll just name it that. So I remember looking at the group chat one day, and it just says EBR taking off. That's all I saw. And then another person started texting EBR with like the eye emojis. And then I remember someone else saying EBR is taking off again. And so then I was like, whoa, 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 what's going on? And then all I see, and this is what really got me going, was this person saying, let's go. Dude, I got FOMO. FOMO. What does that mean? Fear of missing out. When you hear all these things, of course you're going to want to get onto the hype. You get on the hype with anything, and I had the fear of missing out. And so many thoughts were going in my head, like I was going to miss this trade, I'm going to miss making money, I'm going to lose. And no one wants to be a loser, no one wants to lose money, no one wants to miss out on this crazy hype. So out of my inexperience, I looked up the stock, saw that it was growing green, that it was going up, and I grabbed $100 and I put it in the stock. Now, don't let your emotions take control of your actions. You know, many people have spent weeks and months learning about these stocks. So when they trade them or when they buy them and sell them, it makes it seem easy. You see, if you have no experience, you will buy at the peak of the price and sell at the low, resulting in losses. That's exactly what happened to me. The good thing though is that I pulled my money right away once I saw it going red. I pulled it out, but you know what the unfortunate thing is? I had already lost. I had bought at the peak, so there was no way of the stock going up in price. It was just going down. So the moral of the story is don't invest blindly like I once did. And that's my goal, to help you invest wisely. Instead of putting your money in random stocks that could potentially lose value in the wrong time, my goal is to show you what stocks to invest in and what stocks will make you money. And the question is how? And that, my friends, is by using the advice given by Warren Buffett, in where he suggests to invest through index funds. And some quick info. Index funds are a type of mutual fund or ETF that seeks to track the returns of a market index. In today's example, I will use the S&P 500 index to show you. As Warren Buffett said, for most people, the best thing is to own this kind of index fund, as he was referring to the S&P 500. The index fund mimics the performance of the 500 largest companies in the US. And the great thing is that if one of these companies stops growing, let's say starts losing money financially, they're doing bad, they take out that one from the S&P 500 and they add a new company which is doing better and which is growing, which is great because you keep getting growth in the S&P 500. So why invest in index funds? Well, according to the NerdWallet, the average return for the stock market has been 10% per year over the last century. No, this is on average. So this doesn't mean that the stock market was at 10% each year, that it wasn't at a fixed percentage. This is meaning that over the past 100 years, there was some years where it was 12%, some years where it was 8%, some years where it was 2%, but the stock market has been increasing over the past century. And let's be honest, although investing in the stock market does sound a little risky, investing in the stock market has its perks. I mean, it has a better return than most savings accounts. And this is considering the fact that bank accounts just hold your money and you don't even get a lot of return for your money. And this is not even counting the fact that inflation exists. So as you keep your money in the banks for years and years, the value of your money is going down. Inflation makes it go down. Now, it's easy to get started. Many brokerages will offer you their personal index fund and you can use that. But for the S&P 500, I have personally gathered information, since that's the index fund that we've talked about, and I have put together a list of 5 brokerage companies and their index funds that can be beneficial for you. Starting on our list, we have Fidelity Zero Large Cap Index with an expense ratio of 0%. That means every $10,000 invested, it would cost you $0 annually. Next on the list, we have Schwab S&P 500 Index Fund with an expense ratio of 0.02%. That means every $10,000 invested, it would cost you $2 annually. Third on the list, we have Vanguard S&P 500 ETF with an expense ratio of 0.03%. That means every $10,000 invested, it will cost you $3 annually. After choosing one of these or any other index fund that you decide to choose, you can finally start this journey on your way to building your wealth slowly. And it doesn't matter at what age you start, as long as you start. So now I have some final tips that can help you as you continue this journey in your investment career. The first tip is to control your enthusiasm during good times. Congratulations, you're making money, your stocks are working for you, your index fund, the S&P 500 is doing good for you, but you've got to understand for every bull cycle, at one point there is a bear cycle, meaning the stocks go down. So control your enthusiasm. You know, you're doing good, but there are times where the stock market will take a dip and it'll seem like you're losing money, but you've got to understand that you don't lose money, you only lose value in your stocks. You only lose money when you take your money out of the stock market. My second tip for you is become more optimistic when things look bad. A down market should actually cause you to celebrate, and here's why. Because when the stock market is down, when the prices are down, think of it as a sale. You know, your favorite stocks that are a little bit more expensive, and if they're low on their price, you can buy more. You can buy more and more and more. And when the stock market fixes itself and it starts rising again, now you have more stocks that you love, and the prices will go high, making you more wealth and more money. And this last tip is very important, but you get the average return only if you buy and hold. This is super important with the 10%. If you trade in and out of the market frequently, you can expect to earn less, sometimes much less than anticipated. Commissions and taxes eat up your returns. Study after study shows that it's almost impossible for even the professionals to beat the market. So if you can take anything from this video, it's that it's all about time being in the market instead of trying to time the market. And that's all I have for today for you guys, and I hope you enjoyed this video. And if you did, make sure to give it a like, subscribe if you haven't, turn on that notification that lets you notify when I have another video. And like usual, I appreciate all the support from you guys, and I will see you in the next video.